Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, and Arusha Pierce, who joins me every week, is with me as well. He is an O'Neill Global Advisors portfolio manager. And our special guest this week is legendary Joe Fahmy. He is a managing director at Zor Capital, and a lot of great stuff that he has on his Twitter. So if you haven't checked that out, you can find him at jfahmy. Really great stuff that he puts out all the time. So Joe, let's talk a little bit about the flexibility and the adaptability that you have as an investor, and why do you think this is so important, and what kind of got you started down this path?
I think the most important lesson what I love about the markets is that you're learning and relearning lessons. And the biggest one is that word adapt.
Hmm.
So many greats, when you talk about all the greats, whether it's Druckenmiller, Tepper, Arusha, I mean, there's so many greats out there. But I think of Paul Tudor Jones's line that you either adapt, evolve, adapt, evolve, compete, or die. And because we don't want anyone listening to this podcast to die, let's focus on the word adapt. It's so important to be flexible. Stanley Druckenmiller says one of his greatest assets in the past 30 years is his ability to change his mind. I can't think of anything more flexible than David Tepper in 08-09 being short the banks and then literally turning on a dime and aggressively going long in March of 09. So the greats always have that flexibility. How it applies to me is I literally put on my blog coming into this year that I was expecting a 5 to 10% drop in the markets. And I came in very cautious. And if I didn't learn from some of the best and listen to some of the best and be able to stay flexible, once we had that follow through day, we regained the key moving averages and stocks started setting up. I said, okay, you can't have any ego in the market. Who cares if you put something out publicly? You have to be able to adapt to the markets. And I think that lesson that I relearned helped me to quickly adapt to the markets. And one of the things I wanted to ask you guys, working closely with O'Neill, I'm sure he's talked about this, or any, sort of tidbits you like that. I'm sure it's a common characteristic, even with O'Neill, if there's anything that he shared with you on that.
Well, I'll tell you that, when I first started working as his assistant, this was in September of 99. I had, just been tapped as his assistant. I was really thrilled. I had only been working at the firm for 2 years, and we had kind of a rough summer, right? And Bill O'Neill had sent to his clients a letter on how bearish he was. And,
what was this, 98 or 99? Just
99. This was 99. So remember there, 98, we had the long-term capital management and that double bottom kind of form in the NASDAQ. And we came out of it in October of 98. Great move. But, things were really getting extended, right? And he's like, look, we're due for a pullback, and this one's going to be a doozy. So in the summer of 99, he's like, I think it's here. And he sent that letter to all the clients, how bearish he was. And then in October, we got another follow through day. So there's Bill piling back in, right? And I think Qualcomm might have gone through its climax prior to that. And then it actually ended up forming like a high tight flag and then making another 100% move, later in the year, to close out 99. So there were all these opportunities in those last few months before the March 2000 top. And even though he had sent that to all those clients, I remember, talking to him. I was driving him to the airport and he's talking about how bearish he was. A couple weeks later, I'm looking at his sheets and he's loading up, and I'm like, Bill, like, you just sent that letter to clients. And it was almost like, the Ted Lasso line, memory of a goldfish. He's like, what? But I mean, it's, we had a follow through day and all these stocks are breaking out. So it was just so irrelevant to him that he had, put his neck out there with this, call, because he's like, the data's different now. It's a different market. And so you have to participate. You have to do something.
I love that story because it shows the consistencies with so many of the greats. Again, repeating that line, you have to be able to adapt. You can't have an ego. You can't be stubborn. You have to listen to, what's that line? Don't focus on what you think the market should be doing. Focus on what it's actually doing. And it's a similar story where a follow-through day comes in, stocks start to act better. You can either stay, adapt, evolve, or, stay stubborn, or you have to make those adjustments. And so thank you for sharing that, because that's such a great story.
Well, and to your point, Joe, I mean, all of these people that you mentioned, I mean, one of the keys to success in the market is longevity. I mean, just being at it for a long time really can, get that compounding to your favor. And, I just don't see how you survive unless you are willing to adapt, because, things change. What maybe worked in one market maybe doesn't work so well in another. And another thing about Bill was he was constantly learning, constantly trying to find out, hey, what are some different indicators I can use to just get that much better? Here he was, 50 years experience in the market, 50 years plus, and he was still doing studies on, hey, what could make me better as an investor? And I think that's also what makes the game exciting.
So I mean, going off.
Oh, go ahead.
Well, just very quickly, going off the adapting part. Now, I can understand it from Bill's kind of methodology, where you have a follow through day. There are some signals there to kind of get you more objective. But Joe, have you run across, like with Tepper or Paul Tudor Jones, where they had maybe some kind of technical kind of indication or a sentiment type of indication that maybe help them overcome that fundamental bias that was saying that, oh, you should be much more bearish here?
Yeah, I think all the greats have like their own. I don't know exactly what everybody does. I think they have their own, especially when you're managing global macro, you have your own team, whether it's, Hong Kong and London and you at New York, San Francisco, you have offices all over the world. So they have teams working on different parts of the world. But assuming most people listening are not managing a global macro fund, I just try to keep it simple. So I'm sure they do have a lot of information that might override what their thoughts are, and listen to their team. But just for, the average person listening, I think it's best to keep it simple.
For sure.
The other thing I wanted to add really quick is that recency bias can affect us as well. And one of the lessons I remember, millions of lessons from O'Neill, is that, he always says, stay positive. Just when you think it's, the end of the world, like spring is going to show up and all of a sudden new leaders will emerge. And if you go to a weekly S&P chart of 2022, another reminder is that bear markets tend to have 3 legs down. So we had those 3 legs down. And then when we started to roll over in early December of 2022, another clue, and I know we talked about this, Arusha, is that there were 3 weeks tight, the week of December 16th, 23rd, and 30th. And, Arusha, we were talking about, we were still affected from the bear market. We kind of were ignoring it because of the recency bias, but that was a sign, going back to the tightness conversation, of maybe the sellers were drying up, and beneath the surface at the end of December, institutions were accumulating prior to this move in January that we saw.
Well, and I think also an element here behind the adaptability is and something to counter the recency bias is the willingness to accept new data, right? We're constantly getting new data. And I mean, you find this in science too. And I think some of the best scientists were those that were willing to truly look at even their own hypothesis, or maybe what they've, built their career around. Stephen Hawking comes to mind, where he was like, he disproved his own theory, and was glad to do it because he said, look, there's new data that tells me there's something different. And I think especially with, I mean, everyone was so focused on macro, Joe. We were talking about this earlier. It was like the most important CPI and, whatever ever. And everyone was focused on every single thing. But you do have to kind of roll with that new data. What is the market doing now? What is it doing differently? And to your point, I mean, that those tight weeks, that's, if you're not willing to accept new data and see how something is different, you're going to miss some of those best cues.
Yeah, and to piggyback on that, same thing happened after COVID, where the new data that came in was the insane Fed liquidity that they provided into the system with the bond buying. rates at zero and just unprecedented liquidity. That's another example of facts change, the news change, the data changes. You have to be able to change your tune and adapt to the markets.
Mm-hmm. Yeah, and really going back to what you said earlier about simplifying it, for those listeners out there, worried about, do I have to really, how much do I have to pay attention to liquidity, or how much do I have to pay attention to interest rates and things like that? A lot of times, though, the way I look at it is, look, stocks, markets behave a certain way when they're being accumulated, and they behave a different way when they're being distributed. And those tight weeks that Joe was highlighting before at the end of 2022, those are subtle signs of accumulations. Follow through days, stocks starting to emerge out of bases and actually holding and slowly crawling up. All of those things, those are kind of the keys and behaviors that I'm going to pick up a lot better than the liquidity and things like that, at least for me.
Mm-hmm.
Yeah, do your best to analyze what the big institutions are doing, because at the end of the day, they control the markets.
Yeah. And sometimes the liquidity issue, I feel like, especially like that post-COVID, the reasons became a little bit more obvious to me after the fact.
Right.
In the moment, it was just, this is what the market's doing. And
we had a fall through day, right? We had a fall through day. Look for some stocks to buy. We just buy, and oh wow, it starts to work. The market slowly keeps pulling you in, and then eventually, like you're saying, Justin, the liquidity, okay, that makes sense why that was all happening.
Mm-hmm, right. And Joe, I just also wanted to add another example to the three waves down. If we go back to the NASDAQ and in 2003, I mean, I think that was another classic example. This is kind of the first time that I remember Bill really kind of talking about this in a big way. But the NASDAQ, in the moments before that March follow through in 03, it did have kind of a three waves down. It might be a little bit easier to see it on the daily. So you had that big overwhelming move down. But if you go to the daily on it, Arusha, you can also see, and by the way, it was interesting that the accumulation distribution was an A minus at the time of the follow through in March. But
wow.
You can see kind of in that area from December. If you just start in December, there was kind of another three waves down, a very short one, right in there. Yeah. So, it's one of those things where you do this long enough, you kind of see these same things repeat over and over.
Notice the similarities. October low with a surge and a consolidation that comes out around March, April. I mean, it's as you say, the patterns repeat a lot. So,
so to kind of wrap this up, do you have kind of some suggestions for? I mean, to a large degree, you said this at the beginning, Joe. Ego. How you had to put your ego aside. Even though you had kind of made this call and stuck your neck out, you had to put your ego aside and say, okay, things have changed. How do you do that? Is there like a retreat, a man's retreat, type thing where you go into the woods and, how do you get that ego out of play so that you can be more successful?
I think to your point about longevity, you learn your lessons. If you're stubborn earlier in your career and stick to a call, there's nothing wrong with forming your opinion and letting the market prove you right or wrong. And in the past, I would say no, and I'd argue with the market. But now I just don't argue with the market, and I just really try to stay flexible with my approach. But I think we all learn the hard way, and then you eventually adapt, and you just learn to say, okay, I'm going to go with the flow and be willing to be flexible and very open-minded when you're analyzing the markets.